Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, August 12th, 2021. It's 11:34 a.m. Eastern Time as I'm starting the video, and what we're going to do is a very brief overview of the broad markets. There's not a lot new to report there, but I will also cover some indicators I haven't talked on in a while. I think those are worth mentioning, let's just say at the least. A brief update on COVID and what's going on right now with the markets, completely dismissing this pretty much surge in cases with the new Delta variant. So we'll see where that goes. Kids are now starting school again, and there's some hot spots around the country, in Florida in particular, but elsewhere. So we'll talk a little bit about that and what that may or may not mean to the market. Updates on some of the recently highlighted trade ideas like Bitcoin, DM, crude oil, and when I talk on COVID, we'll talk about a few sectors that may be impacted if it continues to get worse, not better there. And then that's it. If any other updates that I might need to do, crude oil, lumber, things like that, time permitting. There's one commodity I wanted to highlight, and that's cocoa, and then should be it. It won't be a super long video. I know I threw out a lot out there, all kind of related, at least in the beginning here, the market. So this is S&P 500. Nothing new. We're inching up. Volatility is extremely low right now. And usually from these periods of low volatility, you get that, and you get the expanded volatility that follows those periods of low volatility. So we'll see what happens there. But as far as the technical posture, nothing's changed now for last week. Negative divergences continue to build. This is the 60-minute chart, that is, of S&P 500, or SPY, the tracking ETF. That's the support zone that I believe will trigger a larger correction if we take it out. Runs from about 438 down to about 436, and then QQQ, same story, kind of boxed in this little sideways range recently, with support down below around 360 or so that will likely trigger a deeper correction if and when that cracks. Until then, markets are kind of in this autopilot, slow grind mode for the last week or so. So let's talk about some indicators first and foremost, and that would be, we'll start out with this one. This is one of many breadth indicators I've already covered for quite a while now. Every so often I'll touch on the sentiment indicators, and nothing's changed there. We're coming off a period of unprecedented bullish sentiment that in the past, levels of those, when you reach those extreme levels, and it's only the extremes with sentiment that seem to have any predictive value. In other words, masses can get a little bullish, a little bearish, but when you're at those extremes that you only see every couple years or so, that's when you usually get the big reversals. And of course, so I'm not going to go into those now. I've covered those quite a bit lately, and we're still coming off a period of unprecedented bullishness on many of the indicators. And these are breadth indicators. So sentiment is how people feel or think, obviously, and these breadth indicators show you really it's sort of lifting up the hood on the market and looking to see what's underneath the hood. And what you look for is disparities, divergences, etc. For example, on this one we're looking at, on the very bottom chart, you have the NASDAQ 100 or NASDAQ Composite right here. This is the NASDAQ Composite. I am not using a log scale, so these what look like little pullbacks are corrections measured well into the usually into the double digits. At least 10% or more, and in some cases, well over 50%. There's a great recession right there, a great bear market from 2007 to 2009. Again, not using log scaling makes those look like little blips, but they were big multi-year bear markets back here and these were drops in excess of 20% as well. So not to be, and what do they have in common? Well, first of all, I'm going back to the 90s right there. That's the late 90s where this chart starts. So I'm showing the divergences. And hey, I've been talking about divergences for a long time. Here's a case where you had divergences building. And excuse me for not saying this earlier. Up top is the NAAD weekly. That is the NASDAQ advancing versus declining issues. So this is on a weekly time frame, kind of paints a bigger picture. And what I like to look for, this is one of my favorite indicators, since the NASDAQ is pretty much the leading index, just a higher concentration of the big growth companies that drive this, the market, Microsoft, Amazon, Facebook, etc. You look for divergences. So when the declining line starts to drop, as it did there, it's going down, yet the market's going up. And that was the same thing leading into the bubble back in 2000. And you had the divergence. And then what followed was a big bear market leading for, again, years. It took years leading up to the highs in 2007, but that was telling us something. And that was telling us that fewer and fewer stocks in the NASDAQ were going up. And so those that were going up were the ones that had the highest weighting. So more and more money is funneling into the big favorites: Apple, Microsoft, Amazon, Alphabet, Tesla now, not back then, Facebook as well, not back then, but now. And that's what's happening. So let's just fast forward. You can look at it. You can see all the corrections that followed. It's pretty dang accurate. There's nothing 100% about this, because the problem with divergences are not sell signals. Number one, they can extend. They can go on for a while. They can get bigger and bigger, and typically result in a bigger drop. Or I've seen times where they get burned through. In other words, this is the NAAD right here falling, clearly going down while the market's going up. That's divergence. That's what you look for. But should all of a sudden breadth start to improve, and you take out that previous high, well, guess what? You no longer have the divergence. But again, we do have it, and that's the reason I'm covering this. And, like I said, this market has been resilient and bulletproof, so we don't have any sell signals. I'm pointing this out. Why? What's the takeaway on it? Well, it says when we finally do get anything more than just a little pullback, it's likely to be a sizable correction due to these internals. Again, the market internals. And I have literally dozens of breadth indicators. I'm not going to go over all of those. It would take forever, and you're going to see, some better than others. But I'm pointing out some of the go-to ones, some of the more reliable ones. This one's a NAHL. That's the NASDAQ New Highs and New Lows Index. Okay, so the number of stocks making new highs, new lows. And the way I like to use this one is I have the NAHL, the black line. It's hard to see on the video, I know that. There's a zoom in right here that zooms in the everything. And I like to run it with a 20 period exponential moving average. That's the red line. And when you get a crossover, typically the NAHL will be above that 20 period EMA. But when you cross, and I don't know if you can make it out in the video, I have red lines and green lines for bullish and bearish crosses. The red lines are bearish crosses. And then down on the bottom, let me change this box color here, you have the corrections. These are, again, bear markets, or corrections measuring into the double digits right there. And there's not many over the years. We've been in a secular bull market overall, but with cyclical bear markets and corrections within there. And you can see we had last signal this thing gave, meaning the lines cross, was a bullish cross right here back in 2020 at that point, shortly after that correction was over, and we remained above it. Forget about where it says MACD. This is a custom histogram I created that shows the differential between the two lines, between that MA, 20 period MA moving average, and the NHL. So on the histogram, when you're above the zero line, which we're here, it means that the black line, or the NAHL, is above the 20 EMA. And it's been there. But what you want to look for is a crossover. It's starting to finally flatten out. And they're pretty accurate when you have a long extended buy signal, as you did back here, and you get that crossover, the lines cross. It is usually a pretty timely indicator as well. It comes early on in these corrections and bear markets as well. There was one right there. You had a little whipsaw first. They kiss back, cross back, and then the real deal set in. So either way, I'm going to watch it. And that's what this zoom in is right here. It's a zoomed in view. There's the NAHL starting to turn down, but not yet moving lower. We'll watch that. And there's the 20 period EMA. And since you're zoomed in really close, it could cross relatively fast. So we'll watch that. And again, one of many breadth indicators. This one happens to be on a buy signal, but I'm monitoring it for a potential sell signal. And then finally, one of, again, what I just think is a great breadth indicator are looking at the percentage of stocks trading above their 200-day moving average or their 50-day moving averages compared to the market. And again, it's a breadth indicator, as one would think. So when you have up top, which you have here, the NASDAQ composite, when it's going up, well, obviously that means the market's going up. That in itself is bullish. However, what you want to see during a rally is you want to also see the percentage of stocks trading above their moving 200-day moving average climbing, and that's indicative of a healthy rally. But what happens is, and you can see here, these are all these blue lines down below. This is the percentage stocks trading above their 200-day moving average. When all of a sudden you have the market going up and fewer stocks are trading above their 200-day, that's divergence, and that again is just a great indication, not a timing indicator, because these are divergences. And again, I have to say it all the time because I get a lot. Divergences aren't a sell or a buy signal, nor are they a timing indicator. They are just they are giving you the conditions in the market. Now they will often give you a heads up. Hey, okay, now we have divergences. The market's been rallying for a long time, but we have divergences in place. So now you might want to be on the heads up for, if you're in an uptrend, that is, you're looking at negative divergences. You want to be on the heads up for a trend change, meaning a correction or a bear market. Likewise, when the stock market's falling, we can sniff out positive or bullish divergences on these same indicators, and you look for the end of the correction and get ready to go long. Again, hopefully you can see this chart in the video. This is a 54% bear market, 20%, 20%. These are all the corrections that came after each and every one of these divergences marked on this chart, going back to 2005 right there. And there it is. We don't just have divergence. It's not the biggest divergence as far as in time yet. It's only started at this point. There's my divergence line. This is the NASDAQ composite up top. But what's scary is how steep the divergence is. Look at the percentage stocks trading above their 200-day moving average. It's falling off a cliff. This is our divergence line. It started out here and it's gotten even steeper from this point right there, that little point with the market just inching up like this. And this is plummeting. And so right there, here's the numbers. This is 50, the 50 level right there. So this says up until recently, well, not recently, earlier this year, about 80% of stocks were trading above their 200-day moving average. That was near an all-time high, about as high as it gets. But right now, we have less than half. And and these lines are headed down sharply. So again, that is telling us that fewer and fewer stocks are moving up, and actually more and more are starting to fall and break down below their 200-day. And again, if you're saying, well, Randy, how is that possible? The stock market's doing great. It's going up. Yes, because of the weighting of these indexes. And in this one, I use the NASDAQ composite. Shows a more balanced index too. But even then, you have just fewer and fewer stocks, your big caps, holding the market up. So that's it. We'll only show you one more and we'll move on because I don't want to beat a dead horse, but just to show you, a lot of these are, telling you the same story. This is, and you'll see it in the S&P 500 as well. I'm just picking the NASDAQ 100. There's not enough time in this video to go over all of the indexes, but this is the NASDAQ 100 up top, and the NASDAQ percentage of stocks trading above their 50-day moving average right there. And the same thing. These are divergences. 54% drop, 19, 18, 17, or 16, 18, 19, and the drops are all measured after the divergences, right? And once the correction started, and the top was in 24%, roughly, these are rough numbers, 30%, and here's our divergence right there. So the NASDAQ 100 continues to climb as the percentage of stocks trading above their 50-day moving average falls, and we're well below that 50% mark right there. So that's, again, that again is just indicative of the current breadth conditions in the market, and sometimes, rarely, but sometimes it will improve. Internals can kind of wash out bad internals, that is, without much of a correction. But again, you go off history and you're looking at these double-digit drops is typically what follows the divergences there. And the when, again, that's why I start these videos out with how the 60-minute charts look. And then if we get any of those sell signals and we start to get a decent correction, I'll turn my focus to the daily and even the weekly charts and then look for sell signals on those time frames, which of course, if we don't have them on the 60-minute charts right now, we certainly don't have them on the daily or weekly charts. Okay, so before we move on to some individual stocks and sectors, I'm going to hit on the what do they call them? The recovery stocks. I forget the term for those. Those coming back online after since COVID. For a while there, they were rallying, but they've really been sucking wind lately. First of all, as I talked about when I covered those in the past, they got ahead of themselves. They were trading above where they were before coronavirus even started, back in 2020, before it really grabbed hold of the economy in the stock market. But this is a heat map right here. You can get this is from Mayo Clinic. There's tons online. You can find plenty of them. Um, I live in Southwest Florida now, but I'm originally from Miami. I have a lot of friends and family there, and I can tell you it is a hot spot. Everybody knows somebody either with corona right now or in the hospital. It's getting pretty bad with this Delta variant, which they say is many, many times more contagious than the old one. Schools just started, so you have all the kids going back to school, and this time around you're seeing, and I've talked to doctors about this, I know personally, and they're seeing younger and younger patients coming in. You're seeing younger, healthy, even teenagers on the vent, things like that. So this one isn't just more contagious. It seems to be more of a thing for the younger people who aren't as vaccinated as the older group. But let's just turn on the heat map. Okay, let's last 60 days. I'm going to hit play down here, and you're going to see. Just look at the scale up top. This is yellow is 0 to 5 cases, daily cases per 100,000 people, and you can see orange, red, dark red, and then black means more. So I'm going to hit play and let you see this. And I'm doing this because I'm surprised to see the market is 110% shrugging this off. And hey, look, this isn't our first rodeo anymore with coronavirus, so I'm already seeing it. Mask recommendations and people wearing masks. Maybe this thing will get checked. Maybe more and more people get vaccinated. I know in this area, most of the locations are out of the vaccine right now. But there it is. You can see it really. Here we go. This is about up to most recent numbers right here, and you just see that heat map going. And this is the forecast right now. Down here, we went into the projections. So that's a pretty clear trend. Okay, and this isn't stuff I'm making up. And again, these are documented cases. So take it for what it's worth. But yeah, the stock market has not gotten the memo. Certain sectors have, and let's take a look at those. This is XAL, and I've covered XAL in the recent past. XAL had big resistance up here, and it ran into about 112.51. And my apologies, XAL, that's the Amex Airline Index, been around forever, tracks a lot of the major airline carriers. Good support down there, and again, I believe I covered that level last time I updated this one, and we're on it now. And that's about 89.50 is support. Where do we go from here? Well, support is support until less broken. So I would say a lot of it, I think a case can be made. You guys know I'm primarily about technical analysis, but I factor in fundamentals. My background originally was in fundamental analysis, even though, again, I believe of the two, technical analysis is better at predicting where things are going to go. But coronavirus and the government's response to it is always a variable, big variable. A fundamental variable. So we'll watch and see how this develops. All of a sudden, do we put the brakes on this surge in coronavirus cases with mask wearing and more social distancing? But is it going to require some shutdowns or limitations, let's just say? I don't even know where we're going to go with it, but it cannot be a net positive. It just can't be a net positive for the airline index, restaurants, hotels, etc. And you go look at some of the individual airlines, Southwest, I'm just going to rifle through them, Delta. You can see my levels. They're all, a lot of these are at support, by no surprise, because the index itself is there. There's United. And you can just see they've been drifting lower lately. And then you have companies, and I'm not going to go over all of them, like Carnival Cruise Lines. Same thing. They got ahead of themselves. The technicals indicated a correction was likely. I don't have the divergence line on the bottom anymore here. That seemed to have disappeared. But you can see there was our wedge right there. Uptrend line, breakdown back test. We went lower. Big support there at 1932. We hit it. So if this surge in cases just dissipates and everything's good, and those that didn't get vaccinated yet decide to run out and get vaccinated quickly, and there's enough vaccines, and it doesn't get out of hand, well, then maybe there's a play to be made there. But if not, Carnival isn't going to be, selling as many tickets or doing as many cruises, and you could come back down and head at or even take out those old lows. I don't know how much longer, these government bailouts are going to last, and at what cost. The airlines had a almost no lose situation bailout. They didn't get grants; they just had outright bailout money, I believe it was, and so it was a huge boon to their bottom line. But next time around, I'll bet you the government will take a stake in those airlines, and which is dilutive. So we'll see what happens there. Anyways, automakers is the other one. We'll look at, yes and no, and depending on, there's a lot of variables there with the chip shortage and all that. But what I'm looking at, a lot of charts with big divergences. This is Toyota right there, negative divergence right there, a little minor trend line, support at 172.87, and an uptrend line that has not been checked in a long time, and I suspect will likely get checked soon. And so there's a swing target. This is the uptrend line I'm referring to. So last time we checked it was right here. General Motors already broke down from its primary trend line. So this one's on a sell signal. It's at support now, 53.60. Next support, 49.27. And could certainly see it going lower if it breaks that. And I won't go over each and every one of them. There's NIO, Honda. Honda broke down, back tested. So I'm seeing some breakdowns here. Ford is right up on the line right now. What happened? It cracked below the uptrend line, but it has support about 1350 right there. And if it breaks that, I would say Ford's coming down to at least that 1120 level right there. And again, it's these divergences and these overbought conditions that tell me that's the most likely scenario. So those are some of the sectors that I'm looking at. And as far as individual stocks, the fact that we're seeing the breadth deteriorating, it does open the door, and I've got to find some more individual stocks. It opens the door for more setups. That's where a flexible trader like myself, I'm just as comfortable going long as I am short, short as I am long. Doesn't matter to me. When you're swing trading, you're dating these stocks. You're not marrying them. You're not buying them to hold for 10 or 20 years. So it doesn't matter whether you're long or short. Get in, get out. And point being that it's probably a good time to run a long-short portfolio, being diversified, long the most bullish names, whether they're individual stocks, commodities, bonds, whatever it is, whatever asset class you're trading, and then have some short trades in there as well. DM is a long. It's really kind of just moving sideways since I first highlighted it. This is a 60-minute chart. It was right around here, and we already hit the first target, and then we hit it again today. And if you kind of zoom in, earnings are out of the way, as I said. I gave you an update on this morning. And we need to reverse. There was this back test of this trend line that we broke above recently. Broke the trend line, hit the first target, pulled back, hit it again, and we made a higher high this morning. They just reported last night. So that's why you've seen some volatility on the stock today. It was up over, I think, 10% at one point. Pulled back. We're still positive, but almost flat right now. Again, I still like it. Not crazy about it, just because it's kind of sputtering around. But if we can power back up, all we need to do is, we already hit T1 several times recently. We just need to pop it again. I think that should open the door for a move up to T3, and quite possibly my fourth target way up there, 1161. So pretty aggressive target. But that's what I do. Same thing with Bitcoin. I've always listed pretty aggressive targets, only because that's the nature of this particular security. Bitcoin, you don't go into Bitcoin for a 5-8% swing trade or rally. It does that in a single day. That's a typical move. So you're looking for, at least I am, every time I go long or short, double-digit returns on this one. And that was it. It was mentioned the other day, just shy of this 39.25 resistance. I think I was at 38.80 or something, whatever it was. And I said, short it there up in 230, up to 39.25, but I wouldn't short above it. And your stop will be commensurate with whatever your target is. So I updated this chart because it's, we've had so many swing trades. It was bearish here. It was mentioned as a short there, hit that first, second, and then third and final target, at which point it was posted as a long trade. It went up, hit long T1, T2, and then kept going after the second target. That's the only targets I listed, although I had these resistance levels from before. And then again, just last week, or was it earlier this week, mentioned it right here. And we had 1, 2, look what it's done since then. I have not modified that line. Failed there, failed again yesterday. We got as high as 39.27, 2 cents above that level. That's close enough for government work, and provided a very objective and short entry. And it's down at this point in time 5.5% today. On the day, it was down a little bit more. And again, these are the targets, near-term targets for this trade, which if hit, that third target, which I'm favoring, would be about almost about a 19% drop. Okay, on the commodities front, recently I mentioned I've been trading, the commodities, especially the grains, long and short, wheat, and I told you I favored, it was more partial corn this time around, and nice moving corn. It's taken off today, and it's hit that 582, 196 target. Just hit it right now. So if you took corn, was in here, it's been floundering around, and what it needed to do, as I said in the last update, which it did, it needed to break this resistance at 558-ish level, and look, took it out, and boom, didn't look back. Nice move up there, 582, 196. Can continue to run. You can trail it up. You could take profits here, get out, but there's your next target up there, 595, 462. Then there was one that I was going to point out the other day. It was on my notepad, and I don't know how I missed it. it clicked when I was watching it today. I jumped over it on a video a couple days ago, and that is cocoa. Cocoa has had, I should say, my apologies, because it was right here the other day. Nice resistance around 25.17 right there, and I was waiting for it to pop that level, which it did. And look, I'm bringing it up because it's still a buy signal. Again, my bad for leaving it out of the video. It's not that it's run away, but starting to move after the breakout. And that was one. I'm going to show you a couple other charts. NIB is the ETN on cocoa, and this is what it looks like. So what happens with NIB, you had this 29.73 level. I've had this here for a while. It was a nice support level back here. You can see all the support we had there. Traded through it there as well. Broke down, gap down below it, and we just broke out above it. Now, more importantly, I've had this trend line here. I've mentioned NIB over the last couple of years is a buy, as a stating this one is in an uptrend. You had a nice clean uptrend line here, and there's been many pullbacks to that trend line, including this one here, and I posted that as a long entry back then on it. We moved up, and we just recently pulled back to the trend line again. So that's the story on cocoa, is that it's in a bull market, as most commodities are. It'll be clearly in a bull market when it can take out this 35-ish level right here, because you have a few reaction highs. That's a big resistance level. But I think we'll work our way up there now as a swing trade. So I think there's some more upside, and let me show you the charts of the cocoa futures longer term. Okay, this is symbol $ cocoa on stockcharts.com. It's the same thing. It's what I was showing you before. I was showing you a 60-minute chart of the futures, symbol /CC if you're trading it. Stock charts does it this way, $ cocoa. It's a continuous contract, and there's that same uptrend line. Again, it's been a bull market bottom back in 2017. And again, it was highlighted there, and another pullback to the trend line. And this is a big level. So if you're swing or trend trading this, that would be a target for you right there, just between about 29.25. And then if we break above that, that would be quite bullish. This looks like a large ascending triangle pattern, so breakout above that level. Again, I would target that, probably get a reaction if and when we get there, but longer term, that would be bullish if we broke out. And last but not least, lumber just can't seem to get going, but I can tell you one thing that it's done. The momentum has turned. Momentum indicators have turned up. We're pretty much right at that previous low back from a few weeks ago. We're slightly below it. And when we took it out, we didn't go down really much impulsively. So this looks to me, again, maybe not, but it looks as if the selling is drying up at this point. And one thing I can say, which I've been saying, we had positive divergence recently. We still have that positive divergence. This is a 30-minute chart, 30-minute candles. If I go out for an hourly chart, you can see the same thing, positive divergence here. Prices making those lower lows. Indicators certainly making higher lows, and again, the whole point of that, it shows the momentum is waning, the downside momentum, and very oversold. We're in a commodities bull market. Just because this one's had a 70% correction, it comes on the heels of a 300 or what was it, almost 400% return to the upside. So it was a biggest rally in lumber futures. So I believe in history. Since COVID, or since the lows back last year, but also followed by the biggest correction. That's the nature of this beast. This thing usually doesn't go sideways. Lumber's like some commodities is either going up or down, and this one's certainly going down. But for the last couple of weeks, we're right about where we were. And again, we have the positive divergences. I wish I could give you a better trend line here or price resistance level, but what I think will do the trick, if you've been holding off and you're a little skeptical on this one because it's still in a downtrend, it still is a catch a falling knife trade, I think that 520.85 level right there will do the trick. I think that'll spark a pretty good rally and bring the buyers in if that gets taken out, and that's LB Lumber Futures. Alrighty, okay, we'll wrap it up here, and again, I'll continue to look for the best looking setups out there, and both individual sectors with sector ETFs, things like that, as well as individual stocks, long or short. This has been Randy Finney with Right Side of the Chart. Have a great day.